10 stocks I'm buying in this bull market. The first stock is Meta. In their most recent quarter, Q1 total revenue was $36.5 billion, up 27% year over year. First quarter operating income was $13.8 billion, representing a 38% operating margin. Income from operations was up 91% year over year. Their net income was up 117% year over year. That's insane. Their free cash flow was $12.5 billion, and they ended the quarter with $58 billion in cash and $18.4 billion in debt. Also, approximately 3.2 billion people use at least one of their apps on a daily basis. There's like 8 billion people in the world, so they have almost half of the entire world using their platforms. Their family of apps operating income was $17.7 billion, representing a 49% operating margin. There are now more than 150 million active users on Threads. This could mean Meta could monetize it, right? So they could put ads on their platform. Meta is one of those companies where they like to scale up one of their products or services and then seek revenue from it, right? So in the future, this could be another growth avenue from them. If we look at their balance sheet, they have 222 billion assets and 73 billion liabilities. Also, like I mentioned with their daily active users, they just keep rising. Now they have 3.24 billion, and it just keeps going up every single quarter. Also, Meta's forward PE is only 23. And remember, they're growing revenues 27% year over year. They have all this cash. Gross profit margin is 82%, and you're telling me it's only one lower than the S&P's forward PE of 22? I don't think the average stock in the stock market is growing their numbers like Meta. Come on. The next stock I'm buying is Palantir. Now, Palantir is up 78% in only the past 6 months. That's a very big run. The average return is 10%. Now, Palantir is a software company that specializes in human-driven analysis using real-world data, so they integrate, manage, and secure data using AI. So in their recent quarter, their commercial revenue grew 27% year over year. Their US commercial revenue grew 40% on a year-over-year basis. Also, their US commercial customer count grew 69% year over year, or 19% quarterly, and their adjusted operating income and operating margin has been increasing every quarter. They have a rule of 40 of 57, which is just their combined revenue growth rate and profit margin, and they've achieved their 6th consecutive quarter of GAAP profitability. Their AIP boot camps has been attracting more businesses using their flywheel marketing strategy. Just when happy customers keep referring other customers, which just drives growth, and the cycle repeats. And they ended Q1 with $3.9 billion in cash with no debt. Also, Peter Thiel, who owns 10% of all Palantir shares, who's a co-founder of PayPal and Palantir. If Trump wins the election, Thiel's relationship with Trump should bring even more growth to their government business. Now, Palantir's forward PE is 86, and I know that's perceived as high, but I think it's justified by their future growth potential. Imagine how many growth avenues they could have in the next 10 years. Also, the AI industry is projected to reach $1 trillion valuation by 2030, and this is only going to increase the software side. The next stock I'm buying is Nvidia. I know everyone's talking about it, but let's ignore the stock price for a second and consider this. They're the leading AI hardware provider, especially in GPUs. They consistently have been beating their analyst estimates and their whisper numbers. Their revenue growth is significantly higher than the market average, significantly. Also, the CEO is coming out and saying that demand for Blackwell and Hopper chips will outstrip supply well into 2025. So they still have demand well into next year, and their strong balance sheet has substantial cash, and they don't have much debt. So yes, I think this stock increase is justified, and it actually has more room to run, because Nvidia is a cheaper stock today than it once was. Now, the forward PE is double the market average, but remember, they're outpacing peers like AMD, so that deserves a premium. And revenue growth is literally 10 times that of the average stock, so that deserves a premium. They're one of the largest companies in the world, so that also deserves a premium. So yes, Nvidia is still a buy. The next company is e.l.f. Beauty. Now, e.l.f. is a cosmetic company that offers cheaper prices for their products, but their products are actually high quality. I mean, their net sales surged 71%, driven by retail and e-commerce channels year over year. Gross margin also increased 71% year over year. Their total assets increased from 595 million to 1.13 billion, and their liabilities stand at 486 million. And this company is crazy. I mean, they're growing 115% internationally. Lines are down the block when new stores are opened. They're quickly rising to the #1 brand in other countries, and much of their social feed has been consumed outside of the US. And keep in mind, we're still in a high interest rate environment. With the Fed funds rate still above 5%, imagine what numbers ELF could put up when the consumer has a little more stability, or when ELF can borrow money easier. Now, a forward PE of 58 seems reasonable given their growth rates. Also, their market potential has been improving because their social media presence on Instagram and TikTok has just increased the brand's awareness and demand. And with all this financial strength, they can invest in growth opportunities and manage any economic uncertainty. The next one is SoFi. Now, this stock has been hit hard this year, down 21% year to date, but the fundamentals in this company are only getting better. If we look at their net loss, they have actually turned profitable on a year-over-year basis from a net loss of 34 million to now a net income of almost 90 million. This marks their second consecutive quarter of GAAP profitability. And their balance sheet is okay. I mean, they have 31 billion in total assets and 25 billion in liabilities. They're consistently growing their members on a sequential basis. Also, SoFi's revenue has been increasing every year. And I think one reason for this sell-off is the high interest rate environment. I mean, SoFi's management came out and said that their lending revenues would only be 92 to 95% of what they were in 2023. And because of this, SoFi's lending business might remain under pressure until interest rates actually start coming down. But when the Fed actually cuts interest rates, SoFi's business model should only become better. Most people won't realize this though until the rates actually start coming down. Another stock I like is Honest. Now, Honest is a personal care company dedicated to creating clean and sustainably designed products. Now, Honest is a small cap. With a $360 million market cap, it's very volatile. Now, this recent pullback we've seen out of big tech into small caps seems likely to continue to me. If you look at the Russell 2000 with all the small cap stocks, it's drastically underperformed the S&P and the NASDAQ over the past few years. A few percentage points down for these big companies results in large price swings for these small caps. I mean, double digit at least. Now, I don't know if rotation has started or not, but I think it officially will when the Fed actually starts cutting interest rates, since they affect the smaller caps much more than the large caps. With lower interest rates, Honest will have an easier time borrowing money and therefore be able to grow their business easier. Also, with the ease of rates, the consumer should be in a better place, resulting in people spending more on clean products like Honest. Also, their gross margin increased 12.8% year over year to 37%, and their net loss was 1 million compared to a net loss of 19 million year over year. So if management can continue performing like this, Honest will become a profitable company. The company ended their first quarter of 2024 with 34 million in cash, which is an increase of 22 million versus the year before. And they have no debt on their balance sheet. So I do think Honest is a good opportunity, especially in this high interest rate environment. The next one is Starbucks. Now listen, Starbucks' recent quarter was not good, but let's not forget the company that we're talking about. They're always busy. They have almost 39,000 stores. And think about the economy we're in. I know I keep mentioning interest rates, but it's true. Interest rates are still at all-time highs, and data shows this has affected the consumer. I mean, in a recent survey, more than 1 in 3 Americans have a side hustle. Why do you think that is? They're using the income to pay for their living expenses. But as inflation cools and the Fed actually starts cutting interest rates, the average consumer will be in a better place financially, allowing them to spend more at Starbucks. I mean, do you really think Starbucks is going away anytime soon? They opened 392 stores in their recent quarter. It's not super growth related like Palantir, but the company is a buy, and they also pay a dividend as well. Now, another stock I like is CrowdStrike. CrowdStrike is a cybersecurity company that detects threats and stops data breaches. Now, the growth numbers on this company are insane. Total revenue on a year-over-year basis increased 33%. Their free cash flow increased 42% year over year, and operating income increased 72% year over year. They also had their fifth consecutive quarter of GAAP profitability. They have 6.84 billion in assets and 4.2 billion in liabilities. Now I think we know no average stock is putting up these kinds of numbers, and because of that, investors are going to have to pay a premium for these kinds of growth rates. I mean, their subscription customers grew 41% year over year, and they raised their full year guidance. They also issued better than expected second quarter guidance. CrowdStrike's forward PE seems expensive from a glance at 88, but their numbers are far better than the average stock. Now, something to mention here is if you've been following the news, I'm sure you've heard about the global tech outage, and it's because there was a glitch in CrowdStrike's software update affecting their Falcon platforms. So what's referred to now as a blue screen of death is what shows up on the devices affected. Dan Ives called this a black eye moment for CrowdStrike, and I agree, this is definitely not a good look. But their CEO is George Kurtz, who has over 30 years of experience in the security space. And if there is a problem like this to happen in another company, I think you would want Kurtz to be the CEO. So this will definitely affect CrowdStrike in the short term, but I do think it's still a good long-term hold. Now, Microsoft is another stock that I think you can just buy and forget about it. I mean, they keep performing in all economic conditions. They're one of the biggest companies in the world. They keep growing their numbers. If we look at their income statement, literally almost every single metric is up on a year-over-year basis. They grew their gross margin 18% year over year, total revenue grew 17% year over year, operating income was up 23%, and their Azure and other cloud systems grew 31% year over year. Also, net income was up 20% year over year. They have 484 billion in assets and 231 billion in total liabilities. With their financial health, they're going to be able to handle any economic uncertainty. Also, Microsoft has so many growth avenues, it's really like investing in multiple businesses. I mean, they own 49% of OpenAI, which is ChatGPT. And at a 37 forward PE, they seem expensive, but their growth rates are double the average stock. And I mean, let's be real, it's Microsoft. They should trade at a premium. Number 10 is Amazon. Look, they just keep getting better. With more than 2 billion global units arriving the same or next day in Q1, Amazon delivered to Prime members at its fastest speeds ever. Net income went from 3 billion to 10 billion. Sales increased 13% year over year. AWS or Amazon Web Service increased 17% year over year. Operating cash flow increased 82%. They have 527 billion in assets and 314 billion in liabilities. Free cash flow went from 36 billion to 50 billion on a quarterly basis. Amazon also holds the largest market share for the cloud infrastructure service at 31%, followed by Microsoft Azure at 25%, and then Google at 11%. Amazon also owns the streaming platform Twitch, and everyone knows about their insane e-commerce business. So Amazon's business is greatly diversified. They trade at a forward PE of 41, but remember, just like Microsoft being one of the biggest companies in the world deserves a premium, they're growing their business on the top and bottom lines, and they're still achieving double-digit growth in a lot of their services. For all these reasons, I think Amazon is still a buy, and really just a stock you can hold in any economy. Now, my investment strategy is just to keep dollar cost averaging. I'm not trying to time it, but I'm just buying at all the highs and all the lows. So there you have it. Those are 10 stocks I think are still buys in this bull market. If you found some value, I would appreciate if you like or subscribe. With that said, J Money out.